Now, in the short term, I'm actually expecting a pullback here, right? So if we take a look here at this trend line, we can see we're connecting this low from the beginning of this first bull move right here. Then when we had the big dip, we tagged it, we bounced up, we broke down. Now we're back to that trend line from the underside, which to me would signal a short-term pullback. But I will say this, at this point, pullbacks for me of significance are buying opportunities, especially seeing the debt passing that 40 trillion. Silver has had a good rally, but when you compare it to the gold move, look at how sharp of a move to the upside gold was. And so this really tells us what is going on. What is the concern here? And it's that the fiat currency system is breaking down, the US debt, etc. I would expect silver to kind of top out around 71, 71.50 and then start pulling back. I will be a buyer around that 50, probably 56 level if it comes back in there. But right now, silver definitely not as strong as gold.
Gold is surging to 3-month highs near $4,630 as fiat confidence erodes U.S. National debt surges past $40 trillion and central banks post record Q2 buying. While silver lags behind gold's explosive breakout, rising Treasury yields and relentless government spending signal a fundamental breakdown in the global currency system that investors simply cannot afford to ignore. In this exclusive breakdown, expert technical analyst Gareth Soloway maps out why gold's massive trendline breakout could face a brief pullback before soaring higher. He reveals key buy zones, including a potential drop for silver down to the $56 level, and explains why he is currently shorting overextended mining stocks. Could this impending pullback trigger the ultimate buying opportunity of the decade, or are the miners warning us of a deeper market correction? Watch until the end to find out. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
If yields continue to move higher, what does this imply for gold as well?
Yeah, and what's so interesting is that usually rising yields have been bad for gold, right? Because you can get a better interest rate or return by buying bonds than what gold could potentially give you. But that was under the premise that the US deficit and debt was okay. As things spiral out of control and we start to see the bonds ignoring the Federal Reserve, ignoring the government, it starts to make people realize that there's really financial issues with fiat currencies such as the US dollar, which is then very, very bullish for gold. And we absolutely have seen gold break out, descending trend line. You can see we hammered on it multiple times, finally breaking out. And what a breakout it's been. Now, in the short term, I'm actually expecting a pullback here, right? So if we take a look here at this trend line, we can see we're connecting this low from the beginning of this first bull move right here. Then when we had the big dip, we tagged it, we bounced up, we broke down. Now we're back to that trend line from the underside, which to me would signal a short-term pullback. But I will say this, at this point, pullbacks for me of significance are buying opportunities, especially seeing the debt passing that 40 trillion. And again, to be clear, it's not like our spending as the US is slowing down at all. All right, we're not slowing down in the spending. The government, the military is going up in terms of its spend. And so we have to assume that the rate of spend is going to increase more and more. There's been no fiscal responsibility. Even the whole Doge thing years ago, that's forgotten. I mean, that's ancient history. And so gold, Bitcoin, I mean, these are all things that now look better and better for an investor.
Well, what about silver? Same outlook on silver?
Yeah, so silver's interesting. So silver has come off of its lows, but vertically gold has outperformed silver here. And again, the main culprit, I think, gold is the pure play on the fiat side of currencies, right? Versus silver is a kind of an offset to the printing of money, but also it's an industrial metal. And so silver has had a good rally, but when you compare it to the gold move, look at how sharp of a move to the upside gold was. And so this really tells us what is going on. What is the concern here? And it's that the fiat currency system is breaking down, the US debt, and etc. Versus silver obviously has that component to it, but also the industrial side. So silver's coming into resistance. It's still a long way off from its recent all-time highs. I would expect silver to kind of top out around 71, 71.50 and then start pulling back. I will be a buyer around that 50, probably 56 level if it comes back in there. But right now, silver definitely not as strong as gold.
What's the likelihood you anticipate that silver goes back to the $56 level? How likely is that to occur in your view?
I think it's pretty likely. Obviously, again,
Mm.
slightly better than 50%. And again, maybe that's not hugely likely, but charts, when they break out, they tend to go back to that former level, right? So if we clear off all these other trend lines that I have, and we just focus on this wedge pattern that broke out, there's often tendencies where charts will break out. We can see a descending wedge. Price chops, it breaks out, then it comes back, and then it makes its bigger move. And so that's a very common setup in technical analysis. And so as a disciplined trader, I'll be watching that. And if it does get there, then that'll be my buy level. But I would say it's about 60% chance that it goes back there to that 56 level.
Do you have a similar outlook on the mining stocks? Because the mining stocks have been vastly outperforming both metals
Yeah, the
in this
mining
case.
stocks have been absolutely incredible in terms of their price action. I'm actually short the miners right now. While I'm not short gold, because I still think gold could be one of the stronger players, the miners have gone up to the point where we are now only, look at this, we're only from the all-time highs. From today's high, we got within 12% of our all-time highs. Now, if you look at gold, gold is still massively away from its all-time highs. It is still 20% away from the all-time highs. And so what we've seen is massive amount of money flow has gone into the miners to try to kind of front run this move on gold, trying to get a better return. As we know, miners tend to move a lot more than gold itself, but they've now gotten too far ahead of their skis, and they likely will pull back. And so for the miners, just as a short-term swing trade, I'm looking for a pullback on those, a retrace. Gold, maybe a small pullback, but I would rather be long gold than the miners at this point. They've just had too far of a run.
The U.S. Treasury just doubled its long bond buybacks and is eyeing the $1 trillion cash pile to force yields lower, yet the market barely blinked. That muted reaction may be the real red flag. With debt already north of $40 trillion, officials look increasingly worried that high rates are crushing housing and threatening midterm hopes. Meanwhile, the S&P shrugs off the pressure, still sitting near record highs as buyers treat every dip like a gift, and strong earnings keep the market's only go up story alive. Watch the dollar closely. It has broken key support and could slide toward 97, even 95 by year end, which normally lifts stocks and metals, but a sharper drop risks importing more inflation and locking in higher rates for longer. The next catalysts? NVIDIA's earnings Wednesday and brand new Fed Chair Kevin Warsh's first major speech at Jackson Hole on Friday. Will those two events finally force the market to confront reality, or will the buy the dip crowd keep the party going? Watch to find out.
So I think the big news, like you said, that's really shocked people, and we saw this last week, is when the bond market reacted to Scott Bessent basically saying, "Hey, we're going to raise our buybacks of these long dated bonds by 2 billion to 4 billion." And now this news today that they might be upping it as much as tapping the $1 trillion TGA. And I think what this tells us a couple things. Number one, it tells us that the government is beginning to get scared that yields are this high. They know that with the U.S. debt at 40 trillion now, that it is unsustainable to be paying interest at these levels. In addition, what it tells us is that they're worried about the impact on the economy. We have the midterm elections coming. They've got to figure out a way, if the Republicans are going to have a shot at keeping the House or Senate, they've got to get these yields down, as we're seeing the housing market slow down. And obviously, we're seeing the competition and these yields go up for any debt. And this goes into, by the way, the debt that the hyperscalers are raising. And there's so much competition for that money that the government needs for the 30-year and the 20-year, that we're seeing these interest rates go up. And like you said, even with today's announcements, yields are not really dropping much. We see the 10-year yield trading down fractionally on the day here. This is the daily candle. So it's not having a big reaction, which it might be even the more scary thing here, that people are just saying, you know what? The U.S. has cooked its own egg here. They've made their bed. They're going to have to lie in it, and interest rates are going to remain higher for longer.
What's your take on the S&P at this moment in time?
Yeah, the S&P again is taking this in stride. I mean, let's be fair, with yields as high as they are, you'd think we'd be more than a couple percent off all-time highs. But I still think that investors have been slowly lulled into this. Markets always go up, and even if they dip, they have a V bottom shape recovery where they go right back to new all-time highs. And so that's keeping the buyers in and buying every dip. And we've seen that. And yeah, the markets have come in just a little bit, but for the most part, they're holding up. Earnings were very, very good. So that's helping the narrative as well. But this kind of feeling that the economy is fine and the Fed is no longer a risk to hike in September is definitely keeping the underbelly going better. I will say that we need to all be watching the Friday speech by Kevin Warsh, the new Fed chair, and that's from Jackson Hole. So I think that will give us a lot of kind of color. We also have NVIDIA earnings on Wednesday after the bell that will also be very important. Now, on a technical basis, markets are okay here. I mean, again, we have this kind of cross section here. We got above it. We broke out. We hit resistance, came in, chopped around, hit resistance here, and have just come back in. But we're still in an uptrend in the markets. And until we break back below this white trend line around 73.50 or so, I would remain neutral to bullish in the near term.
But you're looking at 98.99 right now on the DXY. Are we seeing a weaker dollar coming out of this?
I am. And you can see we had this bigger trend line here, which is marking recent highs and lows, which just capped short-term action, which was when we were around the 101, 150 level on the DXY. We then fell into support, bear flagged, and we've now broken down. So while we could get bounces, what this tells me is this trend line has now broken. That means bounces ultimately end up with further downside moves, and we could likely see the dollar within a month or so back at 97 on the DXY, and eventually, I think later this year, we could be looking at a 95 handle on the DXY. So there is significant downside, which again is one more reason why we probably want to buy pullbacks on gold.
Interesting. What does a weaker dollar portend to the rest of the markets, including gold and silver and the S&P and everything else?
Yeah, I mean, in general, stocks like a weaker dollar, as do the metals, right? I mean, metals are being traded in terms of the dollar. Obviously, that would imply further upside. The markets, the stocks themselves, because we have so many multinational companies like NVIDIA selling their chips overseas, et cetera. So when they convert that back and they exchange, whether it's yen into dollars, if the dollar has weakened significantly, they're getting a better profit margin by that conversion from the Forex markets. And so in general, the markets like that, which gives you a slight positive bias to the markets overall. But I would say there's a slippery slope here, right? I mean, if the dollar really starts to collapse, it becomes something very, very scary to the market. The other thing to remember as a citizen of the US or any country is that when your currency declines in value, it actually increases the price of things. So you can import inflation by a weakening dollar. And we already know that we have an inflation problem. But if you have a weakening dollar, it's likely to exacerbate that issue, which again means rates probably higher for longer is more of the norm now.
The charts and the debt math are sending the same quiet warning. While the crowd chases every bounce in stocks and metals, the real edge belongs to those who stay disciplined, waiting for the clean setups the market almost always offers after a breakout. A weaker dollar and ongoing fiscal stress still favor the long-term bull case for gold and silver, yet the short-term path is rarely a straight line. That's why the next few sessions matter more than the headlines. Watch how price reacts when the noise hits. The disciplined trader already knows where the real opportunity will appear. Stay sharp because the biggest moves usually arrive right after the market thinks the story is settled. Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.